Do you really understand what inflation is? Originally, in the 19th century, the term inflation referred specifically to an increase in the amount of money in circulation. But by the 20th century, the meaning of inflation started to evolve conveniently. It started to encompass not just an increase in the money supply, but also the resulting rise in the general level of prices. So today, in modern economics, inflation is primarily defined as a general increase in prices of goods and services in an economy over time. I'm not saying this definition is incorrect, but it focuses on the outcome, rising prices, rather than the cause, expansion of the money supply. Milton Friedman said, inflation is always and everywhere a monetary phenomenon, produced only by a more rapid increase in the quantity of money than in output. So is slightly changing the definition of inflation to focus only on the outcome and not on the cause an intentional obfuscation or an attempt to absolve responsibility by the parties who are themselves the ones increasing the money supply? I don't know. I'll leave that to you. But what I do want to do is make this real for you, to make it clear that it's not just this little juiced up 2% CPI metric that the government puts out and says, no big deal. This stuff is literally insane, and I'm going to prove it to you. First of all, in the United States, the Fed has a mandate for stable prices. I don't know what your definition of the word stable is, but they interpret stable to mean it only rises by 2% per year. Why 2%? Well, the truth is, it's arbitrary and completely made up. There's no actual reason why 2%. Look that up. You'll find that I'm right. And for them, the good thing about there being no real reason behind 2% is, oh, don't be surprised if they suddenly move the goalpost to 3% when they can't get it back down to 2% successfully. But let me tell you what 2% inflation really means. 2% inflation is nothing more than a promise to you that any dollars that you save, the value and the purchasing power of those dollars will be cut in half in 35 years. They're telling you that's the best case scenario. Work hard and save, and 35 years from now, we'll only have cut the value of your savings in half. Does that sound stable to you? Okay, and getting back to the definition of inflation that I talked about at the beginning, if they can define inflation as change in prices, and they can use this basket of consumer goods called CPI to be the index of those prices, and they can change what's in the basket and what the weighting is of the different items in the basket, well, then they can pretty well keep that inflation metric around 2% no matter what. But if they were to use the original definition of inflation that we talked about, remember, always and everywhere a monetary phenomenon, then they'd have to use the rate of growth of the money supply as the inflation rate. Well, it turns out that the average rate of growth of the money supply since around 1960 is over 7% in the US. 7.3% inflation means the value of your dollar is cut in half every 9.6 years. Yeah, what you should be saying right now is, what in the ever-loving work hard and save will only cut the value of your savings in half in less than 10 years. But we'll gaslight you into believing it's not happening. But don't worry, it gets worse. Look at this chart from the Fed, by the way, of the purchasing power of the US dollar since 1913. And again, this is using their CPI metric. So not the expansion of the money supply, like I said. This is their juiced up CPI metric that's tracking this. And I'm going to try to explain this clearly because this is super wonky the way they've indexed the axes on this. But basically, they fixed the value of the dollar at the period 1982 to 1984, and they called that value 100. Then they show you that relative to that, the dollar in 1913 was at 1,017. Today, it's at 31.7. That is insane. Using their own fake inflation metric, they are telling you the dollar since 1913 has lost 97% of its value. Now, we don't have M2 money supply data from the Fed before 1959. But do you think the expansion of the money supply was 2% or less prior to that? Hell no. So that means the dollar has lost a hell of a lot more value than just 97% since 1913. Stable prices, right? And it doesn't stop there, because the way we talk about inflation pisses me off, because the way they would express what I just told you above is by saying $1 in 1913 is worth $32 today. That's weird. That almost sounds like money is becoming more valuable. A dollar is worth more? $1 to $32. Sounds like it's worth more, right? Wrong. What they should say is $1 in 1913 is worth 3 cents today. 3 cents. That hits home just a little more, don't you think? And again, that's with the CPI metric. That's not with the expansion of the money supply metric. So I've been around in this game long enough to know that people will say, we need inflation so the economy can grow. The economy can't grow unless you expand the money supply. This is just nonsense. There's this UK professor who was saying that, and I made this takedown video of him. If you haven't seen that, go watch that. But you don't need the money supply to grow in order for the economy to grow. It's Keynesian nonsense propagated for the specific purpose of convincing you that everything I said above is a good thing and that the government should have access to a money printer. The other thing people often say is, well, just don't save your money in dollars. Invest it instead. Just buy the S&P 500 and you'll be fine. That's become the conventional investing wisdom. To me, this attitude is so dismissive and frankly, it's so privileged and narrow-minded that it's insane. First of all, in order to understand the problem I'm describing, you'd have to have access to the information about inflation and CPI and them too. And Fred, the Federal Reserve Economic Data, began publishing economic statistics and charts online in the mid-1990s. So I have no clue how you'd get that information before that. So I guess if you were born before the mid-1990s, you're just screwed. If you were born after the mid-1990s, you weren't taught any of the stuff I just said in school, so you had to figure it out on your own. So either way, you're probably never aware of the problem. But even if you were aware of the problem, I'm pretty sure the common refrain advice has always been work hard and save, not work hard and invest in risky assets like stocks. But even if you disagree, and from the moment you were born, your mom and dad said work hard and buy the S&P. Index investing wasn't around until the 1970s. So I guess if you were born before that, you're screwed. Oh, but even if you were aware you should be buying the S&P 500 to beat inflation, stock trading and investing was still basically only available for the rich. You had to have a stockbroker. They charged a high commission for every single trade. Commission-free trading started basically in 2019. That's 6 years ago. Stock trades in 1975 cost $70, and they were still $13 per trade until like 2005. How many normal people do you think had access to that? Oh, and by the way, all the above only applies to Americans. What about people in other countries whose fiat depreciates even faster than the dollar? It's super dismissive to just say, buy the S&P to escape inflation. What percentage of the world do you think even has access to it today, much less in the past, and can afford it? What if, heaven forbid, they could just save in the currency that they earn their wages in? What a crazy novel idea. And that idea works, if not for the existence of the money printer. Do you know why? Because technology and human productivity are naturally deflationary. Prices for everything should be coming down forever. On a fixed money standard, the whole world is working 24/7 to increase your purchasing power. Instead, we have a stable prices mandate of 2% inflation, which means print enough money to not only destroy all productivity gains that would make prices come down, but instead make sure they go up no matter what. What do you think causes wealth inequality to grow more than anything else? It's the constant increase in the money supply. Not with any kind of fair distribution, mind you. What if they said there'll be 2% inflation, but the newly issued money will be evenly distributed to everyone? Hey, maybe that wouldn't be so bad. Prices would rise, but only at a rate commensurate to the increase of your holdings of money. But nope, newly issued money gets distributed tremendously unfairly to those with proximity to the money printer. If you're already politically connected or you're already wealthy, you have earlier and cheaper access to newly printed money. What can you do with it? Buy up all the assets before the market feels the inflationary effects of the newly printed money. So over time, inflation takes effect, prices of normal everyday goods and services rise. Oh, you got a 2% raise last year? Awesome. Well, the money supply expanded by 7%. Sorry. Guess what else rises? Asset prices. Poor and middle class people see the purchasing power of their wages and their savings go down, and the rich who own all the assets see the valuations of their assets skyrocket. And what a shock that we have a tremendous wealth inequality crisis, only growing greater and greater and greater and greater since 1971 when we went off the gold standard. How many times do I have to say in this video? You're getting screwed. So next time somebody tells you we need to have 2% inflation and it's not actually hurting you that much, send them this video. Subscribe to the channel. If you want to better understand why CPI is a scam, like I mentioned earlier, watch this video. And as always, never forget, Bitcoin's inevitable.